Today, we're going to break down a really fascinating case study. Imagine this. A group of university students get a virtual trading fund and a super tight deadline. We're going to dive into their report and see the strategy, the discipline, and, well, the pretty surprising results of their 10-week challenge. So, this was their starting line. 100,000 Malaysian ringgits in virtual cash. That's a pretty hefty amount to test out your skills and theories, especially when you're jumping into the real-world environment of the stock market. Seriously, think about it for a second. If someone handed you that much money with a clock ticking, where would you even start? Well, that's the exact question a team of students from University Science Islam Malaysia had to figure out, and fast. Okay, so here's the setup. This was basically an investment game, a university project to see if what they learned in the classroom could actually survive out in the wild. The mission? Trade Sharia-compliant stocks on the Bursa Malaysia exchange and hopefully grow that fund. And they only had 10 weeks to do it. But here's what's smart. They didn't just jump in and start clicking buy on random stocks. No, they took a really crucial step back to create a solid, structured game plan. They knew that in the world of trading, just winging it is a recipe for disaster. Preparation is everything. And get this quote is pulled directly from their report. It just perfectly shows their mindset, right? They weren't gambling. They were building a process, a methodical approach that was going to guide every single decision they made from here on out. And wow, their prep was incredibly thorough. It wasn't just about the numbers. Of course, they assessed their skills and set clear goals for profit and risk. But look at step 3, mental health prep. They actually focused on the psychology of trading to avoid making emotional decisions. This 5-step checklist shows a level of discipline that, honestly, a lot of seasoned traders could learn from. So, the plan is in place. Now, for the million-dollar question, or the 100,000 ringgit question. How did they actually decide which stocks to buy and sell? Well, they relied on 2 core methods of market analysis, using them together to make their calls. This breaks it down so well. Think of it like this. Fundamental analysis is like being a detective. You're digging into a company's financial health, its leadership, its place in the market, all to figure out its true long-term value. Then you've got technical analysis, which is more like being a weather forecaster. You're looking at charts and patterns to predict what the price might do in the short term. One is the why, the other is the when. So here's how they put that detective work into practice. First, they filtered their list down to only Sharia-compliant companies. Then, they really zeroed in on established firms with rock-solid reputations and stable income. You know, big names like FNN and Gamuda. The thinking was pretty simple. Stronger companies are more likely to weather any market storm. But, knowing what to buy is really only half the battle. Technical analysis gave them the other half, knowing when to buy and, just as importantly, when to sell. It is all about timing. Let's look at a real example from their playbook for the company Gamuda. They're using specific technical indicators here, like the moving average crossover and the RSI. Now, those might sound complicated, but they're basically just tools that help you spot trend changes or tell you if a stock is maybe overbought or oversold. It helped them make calls based on data, not just a gut feeling. And here's another one, this time for Farm Fresh. You can see on this chart how they mapped out key support and resistance levels. Think of support as a price floor, where buyers tend to step in, and resistance as a price ceiling. This kind of analysis helped them set really precise entry and exit points, taking all the emotion and guesswork out of the trade. Okay, this brings us to what might be the single most important part of their entire strategy: discipline. They really understood a fundamental truth of trading, that winning isn't just about how big your wins are, it's about how well you manage your losses. And the main tool they used for this was the cut-loss strategy. You can think of it like a safety net for your money. It's a decision you make before you even enter a trade to sell a stock if it drops to a certain price. It's all about preventing a small problem from turning into a complete disaster. Man, this quote from the students just says it all, doesn't it? They saw taking a small, controlled loss as a victory because it saved them from a potentially catastrophic one. That is a masterclass in risk management right there. And here we can see that principle in action. They bought into a company called Pika at 164, but the price started moving against them. Instead of hoping it would turn around, they stuck to their plan and sold at 159. Yeah, it was a loss, but it was a managed loss. Their capital was safe, and they could live to trade another day. All right, so after 10 long weeks of all this careful planning, deep analysis, and super disciplined execution, what was the final score? How did they do? Well, their performance was a mix, which is exactly what you'd expect in trading. Their single best trade brought in a profit of 104 ringgit with Fraser and Neve. On the flip side, their biggest loss was 61 ringgit on Agricor. It's a perfect little snapshot of the reality of trading. It's a constant seesaw of wins and losses. So, after 220 trades over 10 weeks, after all that work, all the analysis, the wins, and the carefully managed losses, what was the grand total? The final net profit was 87 ringgit and 50 cents. Now, I know what you're thinking. That number seems small, but hold on, because that profit figure is not the real story here. The crucial point is this. They started with $100,000, they navigated a tricky market for 10 weeks, and they ended with more than they started with. Their number one goal wasn't to get rich quick, it was to protect their capital. And by that measure, they absolutely succeeded. Ultimately, the real profit here wasn't something you could count in ringgit. And the students said it best themselves in their report. The true value was the experience. It was about bridging that huge gap between textbook theories and the messy, complex, unpredictable reality of the stock market. And all of this leaves us with a really big question to chew on. What do we actually consider valuable when it comes to investing? Is it chasing that one huge, exciting profit? Or is it the quiet, day in, day out discipline that protects you from a huge loss and keeps you in the game for the long haul?